Hello and welcome back to Bunnex Investment Group. Today we are going to be talking about a simple US30 trading strategy. This is going to be categorized under scalping, since you'll be taking a few pips. It's actually an in and out trading technique. But before we jump into the war video, I'd like to notify you that we are going to have a masterclass, which will be the one for this month. It's going to be starting on 11 and 12th of October. It's actually going to be going for 150 US dollars. And to sign up and book your seat, please use the link that will be right down below in the description box. You may as well check out our free Telegram channel where we share free signals, advice, as well as support. We also put out our announcements in that channel as well. So without wasting much of your time, let's actually first describe what we are going to be looking at on the charts. So it's basically a break of structure, a retest of the break, then a break of the breaker, and entry. So what we just mean is, the first thing is the market will either go up or down. So by going up, we are saying we have a move of this manner where we have higher highs and higher lows. So I've just drawn this. We are coming from this side going up, and we've created a higher high and a higher low. Therefore, break of structure is actually breaking of the last lower low, like this. Therefore, we would say we have broken the market structure. So if we have broken the market structure, what we will be looking for is actually evidence that we are now in a new trend. So that evidence can only be attained by looking at the new pattern that will be given by the market in this sense, whereby we have this case. This is now a lower high, right, and creation of a lower low. So if ever the market creates a lower high and a lower low, our assumption will be we are going to have a lower high for us to continue with the trend. So this lower high is anticipated to occur at the first lower low, right? So if this happens, whereby we've broken structure, we've created a lower high and a lower low, we have actually approved that the trend is now a downward trend using this evidence. So our entry is now going to be in support of this downward trend. So our entry will be at the perceived lower low, like this. This is the point where we will expect to enter the market at this point, and stop loss should always be above structure, that is above the last pin of that lower high, and you should look to get a 3:1 or a 2:1 reward to risk ratio. Therefore, your entry after entry, you are going to look to get 2 parts of what you've risked on your stop loss. So let's go over the charts and see how this can be applied in an actual market, right? So the time frame is going to be M15 time frame, and on this point I'm going to just pick this as my lowest starting point. This is going to be my starting point, and from this point we can see that the market went up, right? when it went up, it broke structure of the prior trend. On this prior trend, we had lower highs, lower lows, lower highs, and the market actually broke these last lower lows. So in this case, after breaking these last lower lows, we now wanted to have proof that the market is now trending up, and by that we can use what we've just described, whereby we need to see a higher high and a higher low. So in this case, a higher high and a higher low was created, and our point of entry was going to be the perceived higher low, right? So it's 1, 2, then break of this higher high, then retest of that higher high was going to be our point of entry, since it's going to be within the market context that we have determined. So our entry was going to be at this point, where we had a retest of our perceived point of entry, right? Then the next thing is, now we are now waiting to see break of market structure. So the market was actually trending up, right? At this point, we reached the highest point, and at this highest point, the last lower high within this trend was this one, and we broke it and retested it, and we now had evidence that we are going on a downward trend. So break and retest this one. We are not interested in trading this one. Why? Because we need to find a perceived point of entry in line with the new market context. So the market context has been created. We are now in a downward trend, and our perceived lower high is going to be at this point, right? Then the market went down and came back to retest that exact zone. So that is where we were looking to get our short trade. At the retest, after the market context has been created, then our short entry was at this point. Then continuing, someone was also going to say we could trade this point. Yes, of course, because there is another break of this long period of consolidation, then retest of that long period of consolidation, break of this point, and retest, and you could also get a short entry. So at this point, what can we see and what can we conclude? We can see that the market is went up. By going up, it is broken structure, and after breaking structure, we have retested the point that we have broken, and we now have more evidence that this asset is now going up. What we now need to wait for and confirm our entry is to see the market come back and creating a lower high, actually a higher low, something that actually confuses, and go long. Sorry. So this is what we are anticipating to see on this asset. So it's basically proof of market context, after proof of market context, and trade in line with the market context, and then we need to wait for a proper retest of what we have actually been issued. So we come to the end of our video, and if you would like to learn more about how to trade these, you may as well sign up for our upcoming class, whereby we are going to go deeper on how to trade using the most effective trading methodology, which is the market maker method. And on that note, we come to the end of our video. Thank you for watching. Like and subscribe.